Have you been hearing that you have to buy a house to be wealthy and that renting is just throwing money away? In most big US cities right now, renting can actually be the smarter financial move, and it comes down to total cost, opportunity cost, and flexibility. Most people fixate on the mortgage, but owning is really PITI, principal, interest, taxes, and insurance, plus your HOA dues, routine maintenance, and transaction costs when you sell. Rates are still elevated, prices did not reset, and big city carrying costs stack up fast. A good rule is to budget roughly 1% of the home's value per year for maintenance on the house. With condos, you often swap the maintenance for a higher HOA fee, but the bill still exists. And if you have to sell, expect 6 to 8% in agent fees and transfer costs before you even pay the movers. Let's make it real. Say you're eyeing an $800,000 condo and you put 20% down. That's $160,000 upfront and a $640,000 mortgage. Around 7% interest. Principal and interest would land roughly at $4,200 to $4,300 per month. Property taxes in mini metros hovers near 1 to 1.25% yearly, so call that about $700 to $800 a month. Add insurance, HOA, and maintenance, conservatively bundle around another $800 to $1,000. All in, you're around $5,800 to $6,200 per month to own. Now compare that to renting a comparable unit in the same neighborhood at say $3,600 to $4,000 a month. Even if we use $3,800, the monthly gap is roughly $2,000 to $2,400. If you rent, you can invest that monthly gap, $2,000 plus every single month, and your down payment stays liquid. That $160,000 doesn't get trapped in drywall. It can compound into a diversified portfolio. So now you have two engines working for you, a lump sum growing over time and a steady contribution stream. That combination can outpace the slower after cost equity buildup of a primary home over shorter horizons, especially when most early mortgage payments are mostly interest. Flexibility is also a hidden superpower. If you buy and need to move in 2 or 3 years, the friction can be brutal. 6 to 8% to sell can erase a ton of on-paper appreciation if the market falls. Renters pivot faster. New job, new city. Better deal across town, you're not committed to one address. There's also concentration risk. Buying concentrates a big chunk of your net worth into one property in one neighborhood. Renting lets you diversify into broad markets instead of concentrating your risk on a single block. Let's talk about some taxes because the mortgage interest deduction gets overhyped. With the standard deduction as high as it is for many households, the incremental benefit of itemizing mortgage interest and property taxes isn't always huge. The SALT caps limit deductions in certain states. Bottom line, the tax angle rarely flips the cash flow math on its own, especially when the monthly owning cost is thousands more than it is to rent in large cities. Now, buying does deliver some lifestyle value. You can renovate, you can control your own space, and you've locked in a fixed payment for 30 years, and you're not dealing with landlord surprises. If you're truly staying for the long term, those lifestyle benefits matter and are hard to price precisely. But remember, lifestyle is a choice. Great if you can afford it and you'll stick around. Just don't mistake it for the best financial outcome in today's high-cost metro areas. Buying wins when the following boxes are checked. 1. Your time horizon is 7 to 10 years or longer. 2. Your total owning cost is close to or below comparable rent after you include taxes, insurance, HOA, and realistic maintenance. 3. The property has strong fundamentals, good schools, a limited supply of housing, strong job base. So you're comfortable riding out cycles there. And 4. You value stability more than optionality, and you won't need to ever sell quickly. Here's a simple decision framework. Step 1, compute your true owning cost. Principal, interest at today's rate, property taxes, insurance, and HOA, plus at least 1% value per year to cover maintenance on the house, or an honest HOA plus reserves for a condo. Step 2, price the exit. Assume 6 to 8% to sell and ask yourself, if I had to move within 3 years, would expected appreciation realistically cover that? Step 3, Compare with a truly comparable rent, same size, parking, light, neighborhood. Step 4, model opportunity cost. What does investing the down payment and the monthly savings look like over your expected timeline if you rent? Step 5, overlay your life plan. Job stability, family plans, school needs, and commute. And how much you value having control over your space. One more piece, discipline. Renting only beats buying if you actually invest the monthly savings. If that money leaks into something like lifestyle creep, the spreadsheet advantage disappears. If you know you won't invest consistently, the forced savings aspect of a mortgage can be helpful, even if the cash flow is higher. So bottom line, with rates still elevated and carrying costs high in many large US cities, renting plus investing the difference often wins today, especially for people with shorter horizons or uncertain plans. If your numbers show a small gap and you'll stay a decade, then buying may be the better option for you, but always run your numbers before you decide. Thanks for watching my video on Mask Money. If you found this video helpful, please remember to like and subscribe.